We are here to try to explain to you what it is we do here.
We are commodities brokers, William. Now, what are commodities? Commodities are agricultural products, like coffee that you had for breakfast, wheat, which is used to make bread, pork bellies, which is used to make bacon, which you might find in a bacon and lettuce and tomato sandwich. And then there are other commodities like frozen orange juice and gold. Though, of course, gold doesn't grow on trees like oranges. Clear so far?
Yeah.
Good, William. Now, some of our clients are speculating that the price of gold will rise in the future, and we have other clients who are speculating that the price of gold is going to fall. They place their orders with us, and we buy or sell their gold for them.
Tell them the good part.
The good part, William, is that no matter whether our clients make money or lose money, Duke and Duke get the commissions.
Well, what do you think, Valentine?
Well, it sounds to me like you guys are a couple of bookies.
I told you he'd understand.
Okay, boys and girls, ladies and gentlemen, I'm Uncle Pete, and this is Uncle Pete's Wall Street. Welcome back. Okay, that clip you just saw is from one of my favorite comedy movies, and in some respects, I look at it as a holiday movie. That's the 1983 movie Trading Places, starring Dan Aykroyd, Eddie Murphy, Ron Bellamy, Don Amici, Denworth Elliott is in it, Jamie Lee Curtis. Very funny movie. Now, they were dealing with commodities, and the Duke brothers were commodities brokers. And when I was explaining in my last videos, video number 5, this is video number 6 in this series, Beginning Investing in the Stock Market. Although they were talking about the commodities market, stock market, stockbrokers, broker dealers, it's still the same. And I just love the line where Eddie Murphy says, sounds to me like you guys are a couple of bookies, which I have to tell you, people, that's really what a broker dealer is. It's a legalized bookie, right? Your broker dealer takes your trades. If you want to buy, it takes your buys. It matches it to someone selling. And whether either of you people, the buyer or the seller, make money is of no consequence to your broker dealer. They still get the commission. Now, I understand in February 2025, commissions on trades are zero for most brokers, right? So how do these broker dealers make money? Well, they make money on their margin book, right? Which is, as I explained before, certain people, certain traders and investors want to borrow money from their broker to engage in certain kind of trades or to create leverage. All right, and I'll explain margin accounts in another video. You're a beginner investor. You don't have no business with a margin account, as I mentioned. And I want to make one other point before I get started in today's video, the topic of today's video, which is going to be, okay, you've been through the last 5 videos on beginner investing series, and you're ready. You opened up your brokerage account. You funded it with $100. Now what do I do, Uncle Pete? That's the topic of today's video. What do you invest your money in? What do you do? Okay, so I understand that a lot of what I say, I'm repeating over and over again in what the hell's the word I want to use? Subsequent video. I'm getting tongue-tied here, right? I realize I'm repeating a lot of things, but you have to understand, repetition is the mother of all learning. The more I repeat these things, the more you'll internalize them, and you realize how important they are, right? Okay. So what you're looking at on your screen right now, I'm in Yahoo Finance. This is the S&P 500. Now, I mentioned this many times, the S&P 500 in my previous videos. The current price as of today, what's today? February 18, 2025 at 1:31 Eastern Time. The price of the S&P 500 is 6,112.33. And what I have here are the historical prices monthly, right, of what the S&P 500 has done over the years. And you could see the adjusted close here where my cursor is. This includes dividends. This includes dividends, splits, any capital gains distributions, all right? So the current price, as you could see, 6,000, about 6,113 of today. All right, here's the date, February 18, 2025. Let's go back in time. Now, this historical data on Yahoo Finance only goes back for the S&P 500. We're going back in time. Keep your eye. Let's go back up again. Keep your eye on this column right here, the adjusted close. This is the monthly closing price. Okay. So you can see we're going back in time where the S&P 500 was lower and lower and lower and lower. Let's go all the way back to the last bit of data available on Yahoo Finance for the S&P 500. And we get to what? We get to January 1st, 1985, right? 40 years ago, the closing price of the S&P 500 was 179.63. Okay? Now, you can do whatever you want. You can figure out whatever you want to do once you've got your brokerage account opened up. I don't tell people what to buy. I only tell them what I've done and where my money is. And back up here, January of 1990, this is when I started investing. Late 89, early 1990. The S&P 500 was $329. Now, I'm going to do a video in the future explaining how I actually got started investing. Who were the people who got me involved? All right. And essentially two very important people. And I'm going to do a future video on that. But here's where I started investing. When the S&P 500 was 329. And as I mentioned in previous videos where I had the chart, right, showing the rise of the S&P 500 over the last 30 or 40 years, this gives you an actual number of when I myself started investing in the stock market. In particular, the S&P 500 through the Vanguard S&P 500 Index Fund. But since I started investing many years ago, there have been new vehicles to take part in the Standard & Poor's S&P 500, notably exchange-traded funds, which I'll show you in a minute. So I started investing here, and keep your eye on this column here. Through time, this number rose, no matter what happened. Right here we had the Gulf War, right, in early 1991, right? No matter what happened, eventually the market came back. Yeah, it had its major dips, it had its little scares, and it had its crashes, and its, not crashes, I want to say, but corrections, right? Because really, there's a lot of people in the business who would say the only real market crash was the crash of 1981. Some people might say October of 87 was a crash, but the market came back so quickly after October 1987 that really you could say it was just a correction. Whereas the crash of 1929, that lasted a long, long time. That was devastating to the stock market and in the economy. Okay. So as we're moving in time, so we go from 329, and in March 1995, the S&P 500 is now at 500, right? And we're moving through time, and it's climbing. Now we're into 700, right? And July 97, this is when you could see how fast the market started moving up because of the internet came into being, and was really making headways into the economy, into our lives. And you could see how quickly the market was going up, right? Late 1997, we're at 970. Finally, in 1998, we crossed over 1,000 on the S&P 500. Remember, just 18 years earlier, it was at 329 when I started investing in it. And we're going through, and now you're going to see in March of 2000, we almost hit 1,500, right? But what happens in March is the internet, the .com bubble on the internet bursts, and we go from almost 1,500 down to 1,420 by May. That was a major shock to the stock market, but that was mostly to the Nasdaq because those internet companies were trading on the Nasdaq stock exchange. They weren't part of the S&P 500 because they had no history. They were not big companies that had a history of earnings and dividends and whatnot. So the S&P keeps climbing, and then we see a correction here, going from about 1,500 to 1,100 in March of 2001, right? And then we have a long correction here after the terrorist attacks. All right, we go from 1,040 down to 911, and then 815. So we were at war here. And then it slowly started climbing again. All right. And then you're going to see, so we're at 1,200 now in February 2005, 1,280. Now we're at 1,400 in July of 2007, and then 1,500 in May 2007, 1,500 right here, June 2007, May 2007, 1,530. And then what happens? We have the subprime mortgage debacle leading into 2008, and we go from 1,530 to 1,330 in February of 2008. And then it falls further. We go all the way to 735 in 2009. So let's take that into perspective here. Look down here, October 1st, 2007, right here. This is before the subprime mortgage mess. The market was at 1,549, the S&P 500. By the time that subprime mortgage mess worked its destruction into the stock market, we lost nearly half its value. The S&P 500 went from 1,550 to 735. That's 2009, right? That's just 16 years ago. Now, I can tell you that there were so many people from this 1550 in 2079 in 2007, October 2007 to February 1st, 2009. This was people getting out of the market, selling their stocks simply because of headlines and fear. The long-term investors like myself, who did not pay any attention to that stuff, any attention to the fear on CNBC, the fear on Fox Business News, the fear on Bloomberg and Bloomberg Radio, all that fear that was pushed at people, at investors, knocked almost 50% of the S&P 500 off. I was buying here. People like me were buying here. We weren't paying any attention to that stuff because we knew it was going to be temporary. The end of the world was not coming. You have to get this into your head. Before you invest a nickel in the stock market, you are going to see stuff like this through your entire investing career. Right? Let's look at it. Here it is again, October 1st, 2007. Right? The market has been doing great. And then the subprime mortgage mess came in. And in less than 2 years, total destruction. Nearly half of the S&P 500 was wiped out. And there were people who were buying here at 1,500 and selling at 735 and swearing off the stock market for the rest of their lives because they just weren't educated enough in how this works. That if you're a long-term investor, you don't pay any attention to this short-term stuff. I know it's scary. You feel like you're going to lose everything, that the end of the world is coming. But that's what the news media does. That's how they get you clicking on their websites. They get you buying their magazines, buying their newspapers, or subscribing, right? Today, everybody subscribes to this or that, right? Then Hollywood comes out and makes all these movies, and they make hundreds of millions of dollars on ridiculous movies, right? Margin Call, The Big Short, all that stuff. I don't pay any attention to that stuff. I never have. Right? And one of the reasons was because of the people that I followed, that I knew were a lot older than me and had the wisdom of the markets and the experience in the markets. They taught me to ignore all this short-term nonsense. So, when I was buying way back in 1990, when the S&P was 329, right? And all through these months, every month I was buying as the market came up. Surely this month in October 2007, I was buying at 1549. If I love the stock market at 1549, why wouldn't I love it at 735? Of course. I doubled down. These were the years where I was throwing a lot of money at the market because I knew it was going to be temporary. It was shocking for sure. It was scary for sure. But the market has done this same thing for over 250 years. Or however many, 200 years, whatever. So after this gets all worked out, what do you see happening? From February 2009 to August 2009, we're up almost 300 points. and it really hasn't stopped since then, right? You see these numbers going up and up and up. And imagine all this while, every 3 months, I'm getting paid a dividend. And my dividend, I'm just buying more shares, which is lowering my cost basis, right? I did a video on cost basis. Go back and search through my videos. I explained how when you reinvest dividends and you dollar cost average over time, your average cost per share goes down and down and down and down. So that when the stock market has these shocks, it doesn't hurt you, right? It's just scary, but you've been investing so long that you're still in a profit. Now, like I said, you do whatever you want. I'm just telling you what I do and what I have done. And at 62, what I'm still doing. Okay, so let's continue. We're in 2016. Let's continue forward. As you can see in this column here, right here in this column, since the subprime mortgage debacle where the S&P was at 735, it's never stopped going up. It just continues its march higher till today. You went from 2009, where it was 735, to today, to at 6112. Now, is there going to be a big correction eventually? Yeah, of course there is. Something's going to happen somewhere, and there's going to be a correction. Okay? So, I have invested my money in the S&P 500. Okay? Let's look at, now I've invested in this Vanguard 500 index. All right? Which is currently, it's a mutual fund currently at 565. Right? So if you look at the historical data for this fund, I think the historical data goes back somewhere like, let's look at the max. So let me show you that real quick. You go to here, you change it to daily, weekly, we're at monthly. Then you go to the date here and just hit the max, right? And you look at this column here, adjusted close. We're currently at 565. Let's see how far back this goes. To 2000 for this fund, but I was invested in the S&P in other ways. It was $78 to buy one share of this fund. All right, but you could also buy, if you decide you don't want the mutual fund, you want the ETF, the exchange traded fund. The Vanguard exchange traded fund is 559, 560, right? Let's look at the historical data on that. I'm not sure how long this ETF has been in existence, but let's do the max. Looks like from 2010. So from 2010, it was at $80 a share, right? Just less than 15 years ago. Now it's at 560 a share. So you can decide what you want to do. Me personally, I invest in index funds or an index ETF, right? It's up to you. Okay. Now let's look at some reasons why. Okay, so there's this company, S&P Global, that does research. And for over 20 years, it says here, our renowned SPIVA research has measured actively managed funds against their index benchmarks worldwide. Okay? And they've researched the buying an index fund versus an actively managed fund. Actively managed fund means a fund where they decide what companies they want to buy or not, whereas the index fund, those funds just buy what makes up the index. In the S&P 500, it's the 500 companies, right? And what this SPIVA report noticed is after 1 year, nearly 73% of active fund managers underperform their indexes across 22 equity categories, means 22 different kinds of stock funds. At the five-year horizon, 95.5% of active stock fund managers lagged their indexes. So if you are a fund manager trying to beat the S&P 500, 95% of you fail to do it. So why pay the higher expense ratio for an actively managed fund that can't beat the overall market like the Vanguard S&P 500, which charges just 0.04%? Remember, I gave an example of a Fidelity stock fund that charges almost a full point of an expense ratio. That's a lot of your money going to pay the people who work at the fund, whereas at the Vanguard Index 500 fund, you're just paying 0.04%. And then after 15 years, there were no categories in which the majority of active managers outperformed across domestic and international equities. Okay? So the bottom line is this is why more and more investors are going to indexing. They're buying index funds. They're just buying the market. Okay? Because they don't want to pay the high expense ratio for an actively managed fund that can't beat the index. It makes no sense. If your fund manager can't beat the index he's trying to beat, why are you paying him all this money to do it? Right? So let's look at one more ETF. This is the Vanguard Total Stock Market Fund, which there are a lot of people who like this fund. This is an exchange traded fund, currently trading at 301. This is the total market, right? And it explains here what this fund tries to do. It employs an indexing investment approach designed to track the performance of the index, which represents approximately 100% of the investable U.S. stock market and includes large, mid, small, and micro-cap stocks. So in other words, really huge companies down to really small companies. It invests by sampling the index, meaning that it holds a broadly diversified collection of securities that in the aggregate approximates the full index in terms of key characteristics, right? And there you have it. It buys the total market. It's trying to replicate the entire market. All right. So in this video, I'm trying to get across to you that once you get your fund, your brokerage account opened up and it's funded, now you have to pull the trigger and start investing in something. Okay. Now, if you don't know what to invest in, you have to think about, what do you want to do? Do you want to sit there and analyze companies? You want to figure out if the management of those companies are good? Like, are you going to sit there and analyze Apple, whether or not they're going to come out with a product that people want? You're going to analyze all these separate companies and decide which ones to buy? If you don't want to do that, or if you don't have the expertise to do that, I certainly don't, you can buy an index fund. Okay. And look, there's nothing permanent here. Once you buy this, as you get more educated and understand risk, and you may want to move out of that fund and put your money into something else, right? The thing is, you just get started, get your money started, and put an amount of money in. Ideally, you want to put 15% of your take home pay or your gross pay into an investment. If you have a 401k at work and they offer some kind of growth stock index fund that mimics the S&P 500, and they really should have that choice, even though sometimes in a 401k the expense ratio is going to be a little higher than, say, if you went to Vanguard yourself, you know. But if they're matching you, you're getting some kind of matching from your employer. It pays to invest in that, right? If they offer, and they should, some kind of growth mutual fund that mimics the S&P 500 and it's an index fund, if that were me working there, I would put my money in that. So you have to think about what it is you want to do. I know a lot of people when they're first starting out, they're thinking, well, I just, people should just tell me what to buy. Like, give me a stock tip, man. Give me a stock tip. That's not, this is not adult like rational investing. Sit around waiting for someone to give you a stock tip. This is not the smart way. All right. And you have to understand that practicing prudent personal finance is part of being a rational adult. It's part of being an adult. You have to understand personal finance and get tuned into it, right? Because there's really no way. Um, there's really no way that you can remain ignorant um, of personal finance and expect to have a life free of financial worries. I don't know how that works. I don't think it's possible. You can't remain ignorant. I just know so many people who are smart people, college educated people, and I'm not saying people who are not college educated are smart or are not smart, because there are plenty of people who are college educated and they have a ton of college debt, tuition debt. That's not very smart, right? But I'm saying there's a lot of people I know who are smart and they don't know a damn thing about investing. And that is freaking scary. I'd be scared if I didn't know that. But the good news is that it's not difficult to understand. I hope that you go back and watch all of my videos from video 1 to now. This is my 6th video on the beginning series, investing in the stock market, right? And at the end of this video, I have 2 books that I'm going to recommend for you to read. All right. They're very simple books that'll explain really all you need to know. Please don't get confused by what you see on TV and the internet. There's so many gurus out there who are trying to entice you to buy their program to trade and trade and trade. Just don't do that. Please read these 2 books that I recommend. Okay. And we'll talk about trading way down the line. All right. So I hope you got a lot out of this video. I hope that you see that you have to get a handle on your personal finance, your expenses, right? And I have some videos coming up of where do you find the money to invest if you're already stretched thin with your finances, between your rent and your food and your insurance and your car payments and your gas for your car. Where do you find this money? All right, we're going to talk about that too. All right, so I hope you got a lot out of this. Please subscribe to the channel. Hit the like button. I got a lot more videos coming. If you are brand new to investing, please watch my other videos and comment on them. Ask me questions. I don't have a lot of subs right now, so I have time to answer a lot of questions. All right. I'll see you in the next video. This is Uncle Pete, and you've been watching Uncle Pete's Wall Street. Good night. Okay. So I said in the video I was going to give you 2 book recommendations. The first one on the left is a little book of common sense investing by John Bogle. On the right is The Index Revolution by Charles Ellis. Start with John Bogle's book first. Look, these are not very long books. They're very short. Okay, and they're written for people who don't know anything about the stock market. So take the time, please, to read them. And you can't. These are not things that you read once. You're going to have to read them a second time. There might be some concepts you don't understand. But if you keep reading and you keep studying, eventually you'll get it. I did not understand everything I read when I first started investing. I just kept reading and kept reading, right? And then you eventually get things. Remember I said at the beginning of the video, repetition is the mother of all learning. And you're going to see a lot of repetition in the books that you read during your journey of an investing career in the stock market. All right. So take the time, read these books. I would suggest read these books before you put any money to work. The stock market has been there for over 200 years. It's going to be there when you're ready. All right. Maybe the first thing you really want to do before you start investing in the stock market and funding your account is get an emergency fund ready. 3 to 6 months of your expenses in cash in a savings account. That would be my first step. Okay? Get an emergency fund ready. 3 to 6 months of your monthly expenses. Get that in a savings account and don't touch it. That's for emergencies. Okay? Get that going first while you're reading these books. Okay? And if you have any questions, my email is unclepeteswallstreet@gmail.com. It should be in the description of my videos. Send me an email. I'll be glad to answer any of your questions. All right? So those are the 2 books that I recommend brand new investors. All right? I'll see you in the next video.
Looking good, Billy Ray!
Feeling good, Louis.